Welcome to Man301, Management 301, Strategic Management. This is Lecture 5, Corporate Level Strategy. It's the online lecture, Semester 1, 2020. The structure is similar to last week, but a little bit different. Normally I'd have a lot of interaction in this week's lecture. We're going to try to do that in a virtual way, because of course it has to be recorded for both Melbourne and Perth. So you're going to be watching this not at the time that it's being lectured, but at a different time. Once again, this has been posted prior to the regularly scheduled lecture time, so you can use that lecture time if you want to. Last week, we had a lot of case videos in between the sections of the lecture. Again, I'm going to break this lecture up into sections. We're still going to have some case videos, but we're also going to give you some corporate websites to visit, like the Woolworths South Africa Group's corporate website, so that you can look at the way they gain strategic advantage through different corporate strategy or the levels of diversification or some of the other objectives that we're going to be talking about today. There'll be a few little brief knowledge checks as well. These are little checklists that we can then later incorporate into our learning and into assisting you in doing your second group assignment, which is the group assignment. Those activities, the case activities and the websites are just explained on the Moodle website. I've decided not to just keep saying the name of each individual case because I'm going to update them in the future and will save me a little bit of work. It's very important, as you know, that I like to keep the cases very contemporary. I've had to rip out the Virgin Australia Airlines case because of that, given that Virgin Australia announced today that they are in a trading halt and they will be bankrupt. So let's look now at what our knowledge objectives are for this week. On successful completion of this unit, of this topic, of this module, students should be able to define corporate level strategy and discuss its purpose, describe different levels of diversification and how they relate to different corporate level strategies, explain 3 primary reasons that a firm diversifies, describes how firms can create value using either the related diversification strategies, which are related constrained and related linked. Then, as an addition, we're going to look at the ways you can create value using an unrelated diversification strategy. And then we're going to spend a little bit of time looking at the incentives and resources that encourage diversification. 1 to 5 are the most important objectives. So let's get started with objective 1. What is corporate level strategy and what is its purpose? Well, corporate level strategy relates back to business level strategy. Last week we did business level strategy. Business level strategy looked at how we made businesses within a firm effective in competing with other businesses. We looked at business level strategy as about the choices we made to achieve strategic competitiveness and earn above average returns. If we think about Qantas Airlines, Qantas International is a business, Qantas Domestic is a business, Jetstar is a business, their Frequent Flyer Club is a business. Those are separate businesses within Qantas. Qantas is a corporation. Corporations have corporate strategy. Corporate level strategy is company-wide strategy. Corporate level strategy is an action taken to gain competitive advantage through the selection and management of the mix of businesses that you're involved in that may be in the same industry or maybe in different industries, but it's normally across several industries across several product markets. Corporate level strategy asks 2 key questions. what business should the firm be in, or what businesses should the firm be in, and how should the corporate office manage its group of businesses to achieve strategic competitiveness and above average returns. And there are different ways that the firm can manage corporate strategy to achieve strategic competitiveness and above average returns. This strategy, or this discussion of strategy, fits within our strategic actions, a strategy formulation section, which is a strategic action of our strategic management process model. So, not all firms have multiple businesses. Not all firms are diversified. So we're going to look at the different levels of diversification and how they align with different business level strategies. So to do that first, we need to first look at the levels and types of diversification. So a firm can have a diversification strategy or pursue a diversification strategy for a number of different reasons. They can have excess resources that they want to put to use. We talked last week about how Apple had an enormous amount of free cash on its balance sheet. Those resources could be given back to shareholders in a share buyback. They could be paid to shareholders in a dividend, or they could be invested in a new and completely different product line. So excess resources or excess capabilities or core competencies that can be used in different businesses are three reasons that a firm may choose to seek a diversification strategy. Diversification strategies play a role in the behaviour of large firms. And traditionally, when we looked at corporate strategy, we were looking at large firms, often large international firms that are developed in developed economies, Australia, USA, UK, Germany. But there are many large firms that operate many different businesses, and they use different core competencies, different capabilities, or they manage the different aspects of the business to achieve, the businesses in their portfolio, to achieve strategic competitiveness and above average returns. Again, last week, we talked about all the different parts of Apple. We talked about all the different parts of Samsung as an unrelated diversified conglomerate in a way. I'm going to define that term later. But the way firms often become diversified is through some type of evolution and growth. We're going to spend some time talking about the evolution and growth of the firm from a single business to a diversified firm, and how that affects structure and therefore how it affects strategy later in the course. But for now, what I want to do is just give you some categories of the different levels of diversification of a firm. So, a firm that has low levels of diversification has 95% of its revenues coming from a single business. That's a single business firm. 95% of its revenues coming from a single business. Murray's Bus Lines is a single business that runs buses. 95% of its revenue comes from its running of buses, its operations of buses. A dominant business firm may have a major business, but it also may have some other businesses that are part of the organisation. But between 70 and 95%, so it's still the main part of the business, is the main source of its revenue. That's called a dominant business firm. So it might be a department store that has a chain of supermarkets attached to it. Dominant business department store, chain of supermarkets. It might be a car manufacturer that also has some other business, aircraft manufacturing. Dominant businesses might be cars, aircraft might be its sideline. So they're firms with low levels of diversification because so much of the revenue comes from one business. A related constrained diversification is one of the two moderate levels of diversification. Less than 70% of its income might come from the dominant business, but all the businesses may share some type of linkage in product or technology or distribution channels. So Qantas is probably a related constrained company. Everything about Qantas is related to its airlines. Its 3 airline operations, its freight operations, even the frequent flyer, which they've talked about spinning off but haven't, are related to the core business. They share product, they share technology, they share distribution linkages, they share advertising. They sometimes share staff. They definitely code share planes. A related, constrained, diversified company. Even their partnerships and their joint ventures in like Jetstar Asia or Qantas New Zealand still share the same product and share the same technology and share the same distribution linkages. A related linked company is a mix between an unrelated diversified company and a related, a single business or a dominant business, a related business diversified company. We haven't talked about unrelated yet, but we're going to come to it. So it's the bridge between related, linked, and unrelated. So a related linked firm may have 70% of its revenue coming from its main business, but it may have some other businesses which only have limited links to the main business. They might share a name, they might share some technology, or they might not. They might share a distribution channel but be a completely different product. Sometimes firms that are related linked have a legacy product that has free cash and they're trying to find a source of growth. Or they're in a marketplace they know will no longer exist as an attractive market and they want to move further, so they invest in a new area and invest in another area. And finally, an unrelated diversified company used to be called conglomerates. These are firms which have multiple businesses that may not have any common links. Multiple businesses that may not have any common links. Wesfarmers used to be an unrelated diversified company. It's probably a related linked company because it has these groups of firms now, groups of businesses, mining, its retail business, that fit within this broader unrelated linked business. Samsung is probably a related linked business, but Hyundai isn't. Hyundai makes cars, Hyundai makes washing machines, Hyundai makes large tankers. Those businesses operate separately in the industrial market. And 70% of the revenue doesn't come from any one of those. Each of those contributes to the way the business operates. And there's no real common links between their car manufacturing and they're scheduled. So that's the types, or the levels and types of diversification that you can have. We're going to take a break now. I'm going to give you some websites to go and look at. And then after that break, we're going to come back and talk about Objective 3.